Hello and welcome back to our third Panopto video lecture. In this video, we're going to go through the answers for 19, 20, 21, and 22. Now, the idea is that you attempted these on your own based on the readings, based on the lecture videos. So if you haven't done that, do that now. Pause the video, give these a good try, and then come back and we'll work through it together. It's very important that you try this on your own so that way you're actually working with the definitions and actively trying to apply those definitions to identify the cost to the cost object. So if you haven't done that, pause, come back. I'll wait. Okay, so how'd you do? Hopefully you did okay. We're going to go through each of these individually, and we're going to explain how we came up with the answers that we did. So before we even go any further, we have to remember that direct costs are easily and conveniently traced to a specific unit of a product. Okay? Indirect costs are not easily and conveniently traced to a specific unit of a product. Okay, so let's look at the first one. Catered food served to a patient. Okay, that's the cost, the food cost. Can we easily and conveniently trace that to a particular patient? We sure can. We definitely can. So that's going to be direct. The second one deals with wages of pediatric nurses. That's the cost. We need to trace that to the cost object, which in this case is the pediatric department. So we need to ask ourselves, can we easily and conveniently trace the wages of the pediatric nurses to that pediatric department? Oh yeah, we sure can. We definitely can do it easily and conveniently. Okay. The third one, prescription drugs. We need to trace, or we need to identify, if it's direct or indirect, the cost of prescription drugs to a particular patient. So we got to ask ourselves, can we easily and conveniently trace the cost of prescription drugs to each patient? We sure can, right? As the department incurs a cost of, prescription drugs, they know who gets what and how much, and they know the cost. So they can easily and conveniently trace those costs, right? There's no calculating involved other than adding up the cost of what you got, or what the patient got, rather. So that's direct. Now let's look at the heating the hospital. We need to know, or we need to determine rather, the cost of heating the hospital, tracing that to the pediatric department. Can we do that easily and conveniently? Now this one might be a little difficult because let's think about it. Technically we could trace the heating of the hospital to the pediatric department. We can take the total heating bill, we can calculate the square foot of the hospital and how much square footage each department occupies, and we can allocate that heating bill based on that occupation rate. But is that easy and convenient? It's not, right? So that is actually an indirect cost. The heating the hospital, tracing that to the pediatric department, we really can't do that easily and conveniently. So we're going to say, hey, this is an indirect cost. Okay. Let's look at the next one. The next one says the salary of the head of pediatrics to the pediatric department. Well, yeah, we can definitely easily and conveniently trace the salary of the head pediatric doctor to the pediatric department very easily. So that's direct. Now let's look at the salary of the head pediatrics to a particular pediatric patient. Well, you might say, okay, can we easily and convenient, or can we trace that? Oh yeah, we can definitely trace that, right? We can create a formula, so to speak. We can take the salary of the pediatric and we can basically, allocate it based on time, how much time this person spends with each patient. We have to figure out the number of patients and then get like an hourly rate kind of a thing and then apply that to the amount of hours that are applied. Is that easy and convenient? No, it's not easy and convenient at all. So if we're trying to trace the salary of the head of pediatrics to a particular pediatric patient, we can't do that easily and conveniently. It's indirect. The next one is the hospital chaplain's salary to a particular patient. Nope, can't do it easily and conveniently. It's the same circumstance, taking the head of pediatrics and allocating that salary to a particular pediatric patient, right? Technically, we could take the chaplain's salary and figure out a way to allocate it and apply it to a particular patient, but we can't do it easily and conveniently. So this is indirect. The next one is lab tests by an outside contractor. Can we trace that to a particular patient? Yeah, we sure can. We have a specific test, maybe a blood test or something that we need to run on a particular patient. We know how much that particular test costs. We can easily and conveniently trace it without doing any calculation. Lab tests by an outside contractor to a particular department. Guess what? We could easily and conveniently trace the cost of lab tests to a particular department. We know how many tests a particular department ordered. We know the cost of those tests. We can easily and conveniently trace those. So that's direct. So the key here is to ask yourself, can I easily and conveniently do it? If you got to take the total cost and break it down and then apply it, guess what? That's not easy and convenient. Okay? So let's look at problem 20. Okay. So problem 20 wants us to figure out the total cost, right? Espresso Amano, and if you guys are familiar with that, it's an actual coffee shop in Lawrenceville. My buddy owns it, Matt Gibas, good guy. So if you're ever down there or in that area, pop in and grab a coffee. Anyways, they operate a coffee shop in Lawrenceville. Okay, they have fixed weekly expenses of $1,200. They have a variable cost per cup of coffee, which is 25 cents per cup. We need to fill out the chart below, and we need to estimate what's the total cost and what's the average cost per cup of coffee at each activity level. So hopefully you remember from the lecture video, and I'm going to type this in. Y equals A plus B of X. What are we saying here? Total cost equals total fixed plus total variable costs. Okay? So, Okay, so our fixed cost here is $1,200. We know that because the problem says, hey, your fixed costs are $1,200, right? That fixed weekly cost, maybe that's the rent that we pay. Maybe we have a fixed salary for the manager of the coffee shop. Okay, so that's fixed. So it doesn't matter which activity level we're in, because we're going to assume that the relevant range is from 2,000 to 2,200. So our fixed costs are going to remain constant over these two activity levels. Okay, so I'm just going to plug that in right now. Now we got to figure out the variable cost. Okay, so remember how variable costs behave. On a per unit basis, they remain the same. However, in total, variable costs change in direct proportion to changes in levels of activity. That makes sense. That makes perfect sense. Because think about it. The more cups of coffee we serve, guess what? Or we'll say they're espressos, okay? The more espressos we serve, the more espresso beans we're going to have to use. Even though we may pay 25 cents per shot of espresso, in total, as the activity increases, that value is going to go up. Okay, so here, this is where our B of X comes in, right? And we're going to say 0.25 times X. And our X is either 2,000, 2,100, or 2,200. So let's look at the 2,000. Okay, 25 cents times 2,000 cups of coffee equals $500. Okay, that means that our total average cost is total fixed plus total variable. The $1,200 of fixed costs plus the $500 of variable costs equal $1,700. That's our total cost. How did I get total cost? I took my total fixed costs and added my total variable costs. Okay, now we got to figure out, hey, what is the average cost per cup of coffee served? That's easy. In order to calculate this, we take the total cost, and I'm going to put it right under here. Total cost divided by cups of coffee served. Okay, so if I take 1,700 and divide it by 2,000, I end up with 0.85. So basically at $2,000, or I'm sorry, 2,000 cups served, my total costs are $17,000. My average cost per cup of coffee is 85 cents. Let's do the same thing. Excuse me. Let's do the same thing looking at 2,100 units. If I serve 2,100 units, my total fixed costs is still going to remain the same. They're 1,200 units, or $1,200. What are my total variable costs now? Well, all I have to do is take my 2,100 units and plug it into the 0.25 times X, where 2,100 is X. So I end up with $525 of total variable cost. Okay, now I need to figure out what is the total cost, meaning how much in total, how much does it cost me to serve these cups of coffee, right? 1,200 total fixed costs plus total variable cost of $525 ends up giving me $1,725. To get the average cup, or the average cost per cup of coffee, I take my total cost of $1,725, I divide it by 2,100 cups of coffee served, and I end up with 0.821. Excuse me, or 82 cents per cup of coffee. That's the average cost per cup of coffee. Okay, let's do the last one. 2,200 cups, right? Fixed costs, they remain the same. We're within the relevant range, $1,200. Now I got to figure out the total variable. I already got my equation, 0.25 times X. What's X? Well, in this scenario, X is the 2,200 units. So 25 cents times 2,200 cups of coffee is $550. What's my total cost? To figure out total cost, I take my total fixed plus my total variable costs. That ends up equaling $17.50. Now, what's my average cost of cup of coffee served? Well, if I take $17.50 divided by 2,200, it should be 0.795 or 79 cents. Okay? Now, I want you to notice something. Look at the variable line. As activity increases, in total, variable costs also increase. Okay? They increase by 25 cents per coffee served. Okay, so there's that incremental change, right? In total, my total costs obviously are going to go up as activity increases. Now let's look at the average cost per cup of coffee. It goes down. It costs me less to serve more cups of coffee. Why? It's because of fixed costs, okay? If you remember in the lecture video, we say we never, ever, ever report fixed costs on a per unit basis because it gives us the illusion that fixed costs will change as activity level changes, right? We know in total that's not the case. However, on a per unit basis, it does. So the reason why the average cups, or the cost of average cup, the cost or the average cost per cup of coffee served decreases is because of that fixed element. The more coffee we serve, the fixed cost per unit has an inverse relationship with activity. Okay, so we take those two increases and decreases on that per unit basis. We're basically averaging them out, and that's why our average cost per cup of coffee decreases. Okay, let's look at exercise 21. Okay, before we go there, I just want to reiterate one thing that's very important. You should definitely study this, put it in your notes, put it on a note card, whatever. Total cost is equal to total fixed costs plus total variable costs. That's a very important concept. Another important concept is being able to know, number one, and kind of conceptually know how variable costs and fixed costs behave, both in total and on a per unit basis. Okay, very important. Now, let's look at exercise 21. Okay, exercise 21 deals with decision-making costs. So we have differential costs, sunk costs, and opportunity costs. You already read the book. You already did the the question portion of the study guide, and we talked about this in the lecture video. Okay, so what I want you to again, you should have tried this already, but what we're going to do is we're going to see which one of these costs apply to our decision. Okay, and if no category applies, we leave it blank. So just looking at the first item, cost of an X-ray film used in the old machine. Okay, we can assume that we have a choice, right? We either get we keep the old machine we have, or we buy a new machine, a new X-ray machine. Okay, that's the choice here. We either, and I don't think that was by the way, this problem 21 came directly from the book, and I don't believe that the book was very clear on what the decision was, right? So what we're going to do is we're going to go through this and we're going to say, okay, based on our decision to use the old machine or buy a new machine, do we have differential, sunk, or opportunity costs? So let's look at the cost of X-ray film used in the old machine. Okay, so Let's think about this one. The cost of x-ray film that we had used in the old machine. Okay, we already bought this x-ray film, right? We already bought it. It's a cost that we already incurred. It doesn't matter if we continue to use the old machine or we buy a new x-ray machine. That cost already incurred. It doesn't matter what decision we make, that's not going to change, right? That's the definition of sunk cost. So the first one is a sunk cost. Now let's look at the second one. Cost of the old x-ray machine. Okay. Again, we have a choice to make. Do we keep this old x-ray machine? Do we use a new, or do we buy a new one? The fact that we paid, I don't know, $1,000 for it years ago has no basis on our decision right now, right? Should we keep it and use it, or should we buy a new one? So that old cost, that's a sunk cost, right? We don't care. It has no ramifications or no relevance for us to make the decision now. So let's look at the salary of the head of the radiology department. Okay, we're in radiology. Should we buy a new machine? Should we not? Well, guess what? The head salary of the radiology department, we're going to have that position regardless if we use the old machine or buy a new machine. It's still there. It's not a differential cost. That cost exists under both scenarios. So it's not a differential cost. It's not a sunk cost because we're still going to pay this person to do work, right? And it's definitely not an opportunity cost. So that one is not applicable. So I'm going to put an NA. It said leave blank. That's fine if you leave a blank. I just want to be a little more to show you that the fact that that applies to that cost applies to none of these cost classifications. Okay. Next one we have is the salary of the head of the laboratory department. Well, guess what? We're still doing x-rays. We still need a head of the laboratory to move people in, take x-rays. You know, I don't know if they still, like they do film and what do they call that when they put pictures in water and they anyways, it doesn't apply because that person's still going to be there, still working. Okay. Now let's look at the fourth one. Cost of new color laser printer. Cost of a new color laser printer. Well, we have the old machine, or we're going to buy a new machine, right? And let's assume for a moment that that new machine uses that new color laser printer, okay? Because it says the cost of a new laser printer, that's a differential cost. Why is it differential? Because that cost differs under each scenario. If I use the old machine, guess what? I don't have that new color laser printer. If I get a new machine, yep, I have that cost, right? Excuse me. The rent space occupied by radiology. Well, it doesn't matter if we buy an old machine or keep the old machine or buy a new machine. Radiology is still going to be there. They're still going to be working. They're still going to have to pay rent. So this does not apply. So it's not applicable. Okay. Let's look at the cost of maintaining the old machine. So we have a choice. Do we keep the old machine, use it, and maintain it as we go along, or do we scrap that old machine and buy a new machine? This is a differential cost because the cost differs under two scenarios. Keeping the old machine, I'm going to have to maintain. There's going to be a cost to maintain that old machine. If I get rid of the machine and buy the new machine, guess what? I won't have to maintain that old machine anymore. So the cost of maintaining the old machine goes away if I decide to buy. That is a differential cost. Now, benefits from a new DNA analyzer. Let's think about this. I have a choice. I'm dealing with x-ray machines, right? Getting an old one, buying a new one. So what is the cost or the benefit from a new DNA analyzer? Well, I won't get that. I won't have that benefit of a new DNA analyzer if I'm taking x-rays, right? So that's the opportunity cost. I'm giving up that benefit of a new DNA analyzer basically because I'm taking x-rays. So that is an opportunity cost. And the last one says the cost of electricity to run the x-ray machine. Okay, this is actually going to be differential. It's a differential cost. Why? And again, I'm making an assumption here. If you put NA, that would be totally acceptable. I would not mark that wrong. Here's why I believe it's a differential cost. We either have an old machine or a new machine. Chances are that new machine probably going to be more efficient, right? Maybe it's going to use less electricity. If it uses less electricity, guess what? My electric bill is going to be lower. So I'm thinking in my mind that there's going to be a differential cost in electricity between the machines that are running. Okay, so and again, if you put NA and said that doesn't apply, and you're assuming that, well, we're using electricity, it doesn't matter if we have an old machine or a new machine, we're still using electricity. That's true. I think I took it a step further and said, okay, well, you know what? This new machine probably going to be more efficient. Okay, so let's look at the last one, 22. And in order to do this, let's see if I can get this a little better for us. Okay, so what we got to do is we have to do two income statements: the traditional income statement and the contribution formatted income statement. You should have had probably very little difficulty doing the traditional income statement. Reason why is you had this in your prerequisite, right? Financial accounting principles. We'll go through it though. It'll be a good refresher. And then what we're going to do is we're going to do the contribution formatted income statement. Okay, which is, you have to get comfortable with that because we'll be using the contribution formatted income statement basically for the entire class. Okay, so let's look at the numbers we have here, right? We sold 20,000 units. Selling price was $30 per unit. They give us a variable selling expense per unit, $4. Variable administrative expense per unit, $2. They give us our total fixed selling of 40,000. They give us our total fixed administrative expense of 30,000, and they give us beginning inventory, ending inventory, and purchases. Okay. So the first thing we need to do, and I'm just going to move this up. First thing we need to do is to make sure, and I'm going to center my line here. We always need to make sure when we do an income statement, it's always in proper form. Okay, so what's proper form? Well, we have the name of the company. In this case, it's Hills Department Store. If you guys are old enough to remember that, kudos. We are doing the traditional income statement. So I'm going to type in okay. And the third line should always be the date. Okay, remember, when we're talking about the income statement gives us gives us data over time from 1 year, from the beginning of 1 year to the beginning of that same year. So I'm going to say 12/31, and I'm just going to put 2001 and then an X. Okay, could be 2019 or the end of 2019, could have been the end of 2018, doesn't matter. This is proper form. Okay, so remember, The format for the income statement, especially the traditional, sales minus cost of goods sold gives you your gross profit less your selling and administrative expenses, then that gives you your net income. Okay, should be a refresher, but let's go through it. So we're going to say our sales. Well, the sales, how do we calculate that? 20,000 units times $30 per unit gives us $600,000. I'm just going to move that over a little bit. Okay. Next, we need to figure out what our cost of goods sold are. Now I'm going to abbreviate that as COGS, C-O-G-S. COGS is just the abbreviation for cost of goods sold. We need to figure this out. Now, what they tell us is we have beginning inventory, we have ending inventory, and we have the amount that we purchased. Very easy, right? I'm going to give you, and I would definitely jot this down for your notes. Take the beginning balance plus what was added minus your ending equals what was used. I'll say that one more time. You take your beginning balance plus what was added, subtract out what is ending, that gives you the amount that we used. We can figure out cost of goods sold by simply taking our beginning balance of 24,000 plus what was added. Well, merchandise purchases for the year were $180,000. Then I subtract the ending balance. The ending balance is that $44,000. That gives me $160,000. Okay. The next thing I have is the next line is my gross profit line. Okay. Gross profit is nothing more than sales minus cost of goods sold. 60,000 minus 160,000 gives me 440,000. Okay. Now I subtract out my selling and administrative expenses. Okay. So, what are my selling expenses? Well, that's easy. They tell me that my fixed selling expense is $40,000, right? So I have 40,000. But to that, I need to add the variable portion. What's the variable portion? Well, the variable portion is $4 times 20,000 units. Right? Where did I get that? Well, they say variable selling and administrative is $4 per unit. I sold 20,000 units. So that must mean the variable portion, just of selling and administrative, is $80,000, plus the fixed portion, which is 40,000, right? Ends up giving me $120,000. Okay. I need to do the same thing for administrative. Administrative expenses, the fixed portion of that is $30,000. So I'm going to take my 30,000 plus I need to add my to my fixed portion I need to add the total variable. Well, I know that the variable administrative expense per unit is $2 times the quantity, 20,000, ends up giving me what? $40,000 in total variable expenses. To figure out what the total admin expense is, I need to add the fixed plus the variable. 30,000 plus my 40,000 gives me $80,000. So I can say then, oh, sorry about that. So I can say then that, and I'm just going to come over here. Sorry, I fat fingered a key there, didn't I? There we go, 70,000. So I can say, so now I can add up the 120 and the 70. That'll give me my total selling and administrative expense, right? Which ends up being 190,000. Okay. Now I can look and I could say, hey, do I have net income or net loss? Well, my gross profit is $440,000 minus my selling and administrative expense is 190,000. I get net income of 250,000. Okay, that's the traditional income statement. Should be very very familiar. Okay, now we got to look at the contribution formatted income statement. Contribution formatted income statement, and here's the way I remember it. The contribution formatted income statement is bad, right? It's racist, it's sexist, right? It's bad. Why? Because it segregates, right? It separates. What does it separate? Variable from fixed, okay? And it makes sense because as managers, we need to know first how costs behave so we can make decisions, right? Well, if I have variable and fixed segregated out, I know how fixed costs behave, I know how variable costs behave. I can make decisions now based on, do I, change my production? Do I change my cost structure? Do I change my sales? How will that impact the bottom line? I think it's chapter 4 or 5, no, chapter 5, I believe it is, cost volume profit analysis. We're going to be using this a lot, this CV or this contribution formatted income statement. Okay, so we're going to do it here. I'm going to come down here and I'm going to put everything in proper form. Hills Department, Company or Store. And here I'm going to say contribution format income statement. Then I'm going to give the date range that it covers. Okay, so it starts with sales, right? I already know what my sales are, right? $30 times 20,000 units. It's still going to be $600,000, right? There's no difference. Okay. Point one thing out before we get there. The net income is the same under both the traditional income statement and the contribution format income statement. Net income is going to be the net income. It's still going to be the same amount. The only difference is how we get there. Okay. Oh, sorry. Okay, so now we need all of our variable costs. Well, what's the first variable cost we have? Well, we're going to treat COGS as total variable. Okay, and we already calculated that, but we're going to do it again. Remember, beginning balance plus what was added minus ending balance tells us what we used. So I'm going to do the same thing. What was my beginning balance? $24,000. Bear with me here. $24,000 plus 180,000 minus my ending balance of 44,000 gives me $160,000. Usually helps if you can type. Okay, 160,000. What's the next variable cost that we have? Well, look here, we have variable selling and administrative. So I'm going to come down here and I'm going to say V period, just to abbreviate for variable, selling. Well, we know it's what? $4 times our 20,000 units. So the variable selling should be what? 80,000. Oh, missed a zero there, didn't I? Okay. The next variable expense we have is the administrative. And we know that the variable admin is $2 times the quantity, which is 20,000 units. That gives me 40,000. Okay? Now, okay. So, if we look back at the contribution margin statement, we had something called gross profit, right? We know what gross profit is, sales less cost of goods sold. Under the contribution formatted income statement, we do not have gross profit. We have what we call the contribution margin, and we abbreviate that as CM. Contribution margin usually helps if you can spell as well. The contribution margin is a very, very, very important number. Okay, we're going to see when we get to CVP analysis that's a very important number, and we'll discuss why it's so important when we get there. Right now, it's important to know that you know basically what is the contribution margin. Well, it's sales less variable costs. Okay, so if we add up all our variable costs, we have $280,000 of variable costs. The 160, the 80, and the 40. Okay, so if I take my $600,000 minus my $280,000 of variable costs, I end up with $320,000 of contribution margin. Okay, now we take all our fixed costs. We know that the selling fixed cost was 40,000, and we know that the administrative fixed cost was 30,000. So that means we have $70,000 of fixed costs. So if we take our 320,000 and subtract out our 70,000, we end up with net income of $250,000. And that's our net income. Okay, so when you look at these together, you see that the net income's the same. Okay, the only difference between these two is how we categorize the costs. The traditional income statement uses product and period costs, right? Cost of goods sold are our product costs. Period costs are our selling and administrative expenses. The contribution margin segregates based on behavior, variable and fixed. Contribution margin exists in the contribution formatted income statement. It does not exist in the gross profit, or I'm sorry, gross profit does exist in the contribution margin income statement. Okay, or damn it, sorry, it's late. Gross profit exists in the traditional income statement. Gross profit does not exist in the contribution formatted income statement. Okay. So I gave you some pointers on some things that are important that you should definitely study. I strongly encourage that you do that. If you have any questions, please do not hesitate to reach out to me. You have the syllabus, you have my cell phone number on the syllabus. I, Text me, it is not a problem. Every semester I always give out my cell phone number, and I tell students, if you have an issue, please text me. You're not bothering me. I welcome texts. It is not a problem. Okay? So thanks for tuning in. You should be good to go now to finish your Connect and your quiz. But if you have any questions in the meantime, again, please text me. It is not a problem. And get ready for next week, chapter 2, where we cover job costing, which is so fun. Thanks for tuning in, and we'll talk to you guys soon.